This video is going to go over how to use narrow range patterns to find likely trends. Narrow range patterns are basically periods of low volatility that tend to precede periods of high volatility, which we like to call trends. It always helps when you see these narrow range patterns, and that's on the chart here. You can see a couple of them the previous day, and then this big trend that moved after it. And it took it a while before you got another pattern today. The trend was obviously up, the daily trend's up, the weekly trend's up. The only thing I don't like about this particular trade is the price was above the upper containment band at first. So, if you bought right here, knowing that the market's up potentially a little bit too much, you may not have the biggest profit in this. You can see it shot up from around 20 all the way up to 33, and you might have only made 4 or 5 pips in this. But typically, when you see these patterns, they don't always lead to profitable trades immediately, but if you see a breakout that fails and then it breaks out through the low, typically you're going to have a big trend to the downside. If the first breakout fails, when it breaks out above there later in the day, you tend to have nice profitable trades. Here's your first profit target, here's your second. Sometimes it overshoots it a little bit. I might have to zoom out a little bit more to find the correct swing low, which is probably right here. And you can see that's where the Fibonacci area went to. You would have bought this second time here at 31 and exited somewhere up here for a nice 35 pip win. Pound dollar. Another nice thing about these is sometimes you get 2 narrow range patterns in a row. This one's also clearly above the upper containment band, and it's not up statistically too much. You had a very low volatility period, and then the previous 4 hour had another low volatility period. And so when it broke out right here, anytime you have 2 narrow range patterns in a row like this, very tight, less than 10 pip range, you want to put your stop underneath those narrow range areas. And you can see this went up and then came back down. If it didn't shoot up again, I'm out of this trade. And then it shot up to the upper containment band Fibonacci area. And more than likely, this is approximately where I would have exited the trade at 93. You're in this trade at 62 for about another 30 pips. Here's a narrow range pattern, but keep in mind the price is above the hourly, so it's much more likely to go up. The daily trend's up, the weekly trend's up. We only want to take narrow range breakouts when it's above the hourly and it breaks out above the bar. If it's below the hourly, you want to sell the low of the narrow range. So when this breaks out right here, it's not really likely to go below the hourly moving average, and underneath there we have 2 other support areas, monthly pivot and this. And of course that's where it goes and stalls. If you're a scalper and you realize that your potential profit target on this is only 10 to 15 pips max, by all means take the trade, but it's much better when the breakout happens to the upside, as you hopefully will see in other examples today. Here's 2 narrow range patterns, and the second 4 hour period was a little bit lower volatility, but not quite as substantial as the pound dollar here. I really like seeing 2 narrow range patterns in a row with a super tight second one. It almost always leads to a nice 30 pip trend. This one had 2 narrow range patterns, but it was quite a bit smaller. Now this one broke down underneath the low, and it's also underneath the hourly, but you can see the daily, weekly, monthly trends up. So again, you still got to take the trade. Sometimes these things can go 30, 50 pips, but you're fighting a longer term trend, and there wasn't a whole lot of pips to be had in that case. This is a much better example. 2 narrow range patterns in a row again, and you also have a very tight one for the previous 4 hours. And when it breaks down right here, you go short. Keep in mind the lower containment band oftentimes is the end of the move. So when it goes down and hits your trailing stop, you're out of this trade right here at 92.04. You would have been, you only made 10 pips. It came back up, and it wasn't able to get back inside that range. And when it falls again, you go short again. And it came back down and double bottomed. And then it came up again. And always watch previous swing highs. When a currency's making a series of lower lows and lower highs, and when counter trend moves can't break the previous swing highs, oftentimes you're going to get another big move. And this third trade from here is the one that really, paid off. It went down 10, 20, 30, 40, 50 pips. And again, it's way underneath the lower containment band, so when you're watching this on your tick charts or your range charts, any sign of it going up, you probably want to get out of this trade when it goes above these bars high here at 72. You would have been short somewhere around 11. A lot of times I like to wait for currencies to go above the previous 4-hour bar's low, which is this yellow line here, and then go back underneath it. And that way you can have a tight stop, short at 14, 3 extra pips profit in this case. Here's one. Dollar CAD has a 4-hour period of low volatility, and we draw it on the next 4-hour bar. So as soon as there's a low volatility period right here, it starts showing up on the next 4-hour bar, and it plots the previous 4-hour bars high and low. That's what the yellow lines are. When this breaks down right here, you go short, and you can see this one fell about 25, 30 pips. It's not the best trade in the world because it is underneath the lower containment band, and more than likely I would have got out of this trade myself here at 19. So short around 34. It's barely a 15 pip win. Here's an example of a narrow range pattern you would have got in, went against you, came back up, failed to go higher. You can see the statistical strength ran out. And then here you got a counter trend signal. These 3- and 4-hour trend reversal signals usually the end of the moves. So, the market can, and every once in a while does, make a 30 or 40 pip higher high, but usually that's the end of the move. So if you took this trade right here and you had your stop underneath the low here, you can see you got your trailing stop got you out pretty much a break even. These trend reversal signals at the end of the move. The only good part of this trade is it's not way above the upper containment band, and the daily, weekly, monthly trend are in your favor. Here's a good pattern. Unfortunately, it's not the best trade in the world. You can see it's one of the strongest currencies. Daily, weekly, monthly trends extremely strong. Narrow range pattern right here. You buy the breakout. Because it's such a tight 15 pip range right here, you might want to put your stop underneath the low. And it's kind of chopping around right here. So if it doesn't continue up, you usually want to tighten your stop. And then later on, you can see this does break out again and continues up, and your trailing stop got out at 30. So it's about a 20 pip win. And a lot of times these narrow range patterns lead to further trends. If you get a nice move up and a nice pullback, you want to buy the pullback. In this case, it made a nice move up and went sideways for a couple hours. It kind of reset itself a little bit. Traders were not selling up here. It's above the previous day's high, and there's no selling. There's enough selling to stop it from going up, but not enough selling to cause it to reverse. Here's the next profit target, and above that we have my nightly Fibonacci profit target level. I spend 30 or 40 minutes a night, so you don't have to. And you can see, look, it went to the pip at 1.618. So the second trade right here, you would have got in around 48. Put your stop underneath here. And here's your first profit target. Here's your second. Because it's so far above the upper containment band, when it went sideways right here, I would have just exited here at around 74. But that's about a 24, 25 pip profit as well. Here's another one. Breakout. And if you use your trailing stop, you're out. And it's pretty much immediately right back in at 85, and you're out here at 01. And this is what I meant by a pullback. You have a narrow range pattern, which oftentimes lead to significant trends, and in here you got a decent pullback. It's also pretty much right at the upper band, so it's not too risky. You draw your fibs on the last wave, and you're buying it right here with less than a 10 pip stop, and your profit target is about 30 pips away. I mean, and you're trading in the direction of the daily, weekly, monthly. So I'll end this class showing, leaving this up, because this is a textbook perfect example of how you use these narrow range patterns. Not always does narrow range breakout work, but typically you're not going to lose more than 6 or 7 pips, and then usually at the next trade or the trade after that, you're going to get those tiny amount of loss back, plus a lot more, as you can see.